Hi, I'm James Dunn. Welcome to the Inside Network.
Welcome to INDepth, and joining us today is Susan Kasser, Co-Head of Private Credit and Portfolio Manager, Private Debt at Neuberger Berman. Susan, could you expand on Neuberger Berman's capabilities in the private debt market and your particular focus?
So we manage $13 billion of investor capital, mostly from global pension funds and insurance companies, that is focused on U.S. direct lending. So think companies that are owned by private equity funds, operate primarily in the United States, and have anywhere from 50 million to 250 million of EBITDA. The loans are privately sourced, privately negotiated, privately held, and we lead 90+% of our transactions. The benefits of all of this is better credit documentation, low volatility to the investors. We focus almost exclusively on first lien and unitranche loans, so highest place in the capital structure, lowest risk of loss for investors. And 95+% of our loans are variable rate, so investors benefit as interest rates rise. Last but not least, because it's a private asset class, we do benefit from information and market access asymmetries, which are good for our investors, and over time have been able to lead to consistent outperformance by some managers in the asset class.
What have been the driving factors behind the popularity of the sector and how it's performed since the onset of the pandemic back in early 2020?
So the most popular aspect of the direct lending asset class is the contractual cash coupon, which we receive quarterly and in cash, and we distribute to investors quarterly in cash. If we think back to the worst part of the pandemic and economic shutdowns, 99% of our portfolio was generating full contractual coupon as expected, and we were distributing that to our investors, who were very happy to receive it in such an uncertain and volatile time. Since then, we're back up to 100%. Other aspects that make the asset class very compelling to investors are its variable rate, so in a rising rate environment like today, investors directly benefit. It's senior secured credit, so it's the least risky part of the capital stack, lowest probability of loss. And because it's private, there's opportunities for better credit protections for the investors, as well as low volatility in an uncertain environment.
Being an asset class with an asymmetric risk-return profile, where do you apply the greatest focus when assessing the risk-reward opportunities within any investment you're looking at making?
I love that question because I think it really gets to the heart of the matter. Being a credit investor is all about avoiding mistakes. It doesn't actually matter if you pass on a loan that turns out to be good. What you want to do is never invest in a loan that turns out to be not so good. So one of the differences we think about the way we underwrite versus other people is that we don't do it in an iterative fashion. For example, we don't try to price risk, we try to avoid risk. Here's a list of examples. If we look at the industry, is the industry growing and recession resilient? Is the company market leading and valuable? Is the degree of leverage on the business sufficient, not too much, even considering a wide range of potential downside scenarios? Is the credit documentation sufficiently protective? Is the private equity fund that's buying the company experienced, professional, and has consistently treated creditors with respect? If we end up restructuring and owning the company, is there a likely strategic acquirer who will buy it in excess of the value of our debt? And when you look at the company under a range of scenarios, do you think that it is worth probably at least twice or more the value of your debt? I think a lot of other people will toggle some of these risks against each other. So for example, you might look at a company and say, well, it's a very good company, but it's not operating in a growth industry. You might say, I can adjust for that by increasing the price of my loan or reducing the total quantum of debt on the company. We would just pass. You could look at a company and say, well, the free cash flow is pretty tight, so maybe I'll fix that with a bunch of covenants and I'll increase the pricing on the loan. We would just pass. And so when you look at our track record from inception until today, we've invested about $13 billion in over 200 companies, and our annualized loss rates are 0.02%. And I think that that is the factor that makes investors happiest with us, not incremental pricing, but avoiding losses at almost every time.
Liquidity remains a central discussion point for both retail and institutional investors. Is the value of liquidity overstated in your view? And what should investors be focused upon when deploying capital in the sector?
It's true that because the loans are privately sourced, privately negotiated, and privately held, they're illiquid. It's also important to remember that there are a lot of benefits because the loans are illiquid. So since they're privately negotiated, they generally have tighter credit documentation. Because they're privately held, they don't have price volatility the way a liquid market would have. But that said, they are illiquid. Now, compared to other illiquid asset classes, private credit is much less illiquid. That's because the loans are outstanding usually for 3 to 5 years, not longer, and they generate anywhere from 7 to 10% cash coupons, which does moderate the illiquidity somewhat. What we have seen investors do is create a budget for illiquidity the same way that they would create a budget for risk, and then they allocate to this asset class or other asset classes accordingly. What we don't recommend is options out there where you package illiquid loans into a structure or a vehicle that does promise investors illiquidity. We have not found that to be a safe solution for investors.
Given the less transparent nature of the industry, how important is direct origination in building portfolios and negotiating terms? And what are Neuberger Berman's capabilities in this regard?
Direct origination is very important because the more you see, the more selective you can be. And in credit, avoiding mistakes is everything. So selectivity is key. What makes Neuberger quite differentiated in this regard is private equity funds, which is the source of direct lending opportunities, see Neuberger in two different but complementary roles. On the one hand, they know us as a direct lender, capable of writing individual checks of up to 400 or 500 million in a single loan. But they also see us as an investor into their private equity funds. And in fact, a related part of Neuberger is invested in about 600 private equity funds and deployed $6 billion into private equity as an LP just last year. And what this means is private equity funds both have a reason to show us opportunity for direct lending, but perhaps most importantly, to show us the next opportunity and the next and the next and the next, even as we continue to decline many of the opportunities that we show them. And so we decline about 94% of what we see, but we still have deal flow of about $5 billion a week. And that's really because we're both an LP investor in the private equity funds and a direct lender to the companies.